Hey friends, tax season is coming. I've got you covered with a 12-episode Saturday series running January through April. Each week, I'll share tips to help small business owners avoid tax season stress, get clarity, and lighten the load by delegating what you don't need to carry. Tune in every Saturday and step into tax season with confidence.
Here's some of the things I've heard from some of my clients. I make about 50% profit, or sometimes I make 20%, not sure. And someone actually said to me, I think I actually lost money on that project. If this describes you or your business in any way, you have a profit problem and a tax problem, because when you can't predict your profit, you cannot predict your taxes. And when April arrives, you'll be hit with a tax bill based on revenue you thought was profit but actually wasn't. What if there's a formula, a reliable, repeatable formula that you could use consistently to ensure you have a 45% profit margin on every estimate, and lets you calculate your tax obligations accurately throughout the year? I'm Patricia Oholeguy, and today I'm revealing the 45% profit formula that transforms businesses from profit guesswork and tax panic to profit certainty and tax preparedness. This isn't about charging more, it's about knowing what to charge and what you'll actually keep after taxes. And this is Tax Season Saturdays. Let me tell you about Sarah, an interior designer who finished a $25,000 project and actually lost money, but the tax consequences were even worse. She guessed at cost. Fabric she estimated about $2,000 actually cost $3,500. She forgot delivery fees, storage costs, credit card processing fees. She had no markup consistency, just random percentages that felt right. Here's the tax disaster. She invoiced $25,000, so that's what showed up as income on her Schedule C. But because her estimation was so far off, her actual costs were much higher than anticipated. However, she couldn't prove all of those costs because she hadn't tracked them properly by project. The IRS saw $25,000 in income. Sarah knew she barely broke even, maybe even lost money, but without documentation connecting expenses to that specific project, she couldn't prove it. She paid taxes on profit that didn't exist. And because her profit margins were all over the map, she had no idea what to set aside for quarterly estimated taxes. Some quarters she set aside too much money and created a cash flow problem. Other quarters she set aside too little and faced penalties. This is why accurate estimation isn't just about profitability. It's about tax survival. When you cannot predict profit, you cannot predict taxes. And unpredictable taxes creates cash flow chaos and painful April surprises. What should you actually include in estimates to ensure consistent profitability and accurate taxes is being planned for? The first thing you want to think of is materials plus waste factors that the IRS accepts. Never estimate materials at exact cost. The IRS understands waste and accepts reasonable waste factors for your industry, and typically that can range between 10 to 25%, depending on your work. This isn't padding estimates dishonesty, it's realistic costing that tax law recognizes. Secondly, labor plus the full tax burden. This is critical for tax planning. If you're paying someone $25 an hour, your true cost is really between $35 to $40 per hour when you factor the 7.65% employer payroll tax, workers' comps, and benefits. Thirdly, the overhead allocation using IRS compliant methods. For example, your rent, insurance, software, and utilities must be allocated across projects somehow. The IRS requires reasonable allocation methods. You cannot just make up numbers. Commonly acceptable methods include allocation by project hours, by project revenue, or by square footage for different project types. In our Clarity Compass membership, we teach you allocation methods that are both accurate and for profitability and defensibly if your IRS questions them. Every Monday night, we work throughout these calculations for your specific business. Then we have the additional component, profit margin, the only money you keep after taxes. That 45% formula assumes a 15 to 20% net profit margin built into pricing. But remember, if you're a sole proprietor or LLC, you'll pay self-employment tax plus income tax on that profit. Your profit margin needs to account for the taxes you'll owe on it. When you properly include these components, including the tax implications, your pricing creates both predictable profitability and predictable tax obligations. How do you build your specific formula that protects your profit and plans for taxes? Start by tracking actual versus estimated costs for 3 months. Document everything meticulously. This creates the data foundation for both better estimating and better tax planning. When you know your true costs, you know your true profit. When you know your true profit, you can calculate accurately quarterly estimates. Find your patterns and adjust the multipliers. Maybe you're consistently underestimating by 40%. Now that you know, you need to increase your estimates by that amount to make sure that you're not going under. And maybe the materials in your industry run 18% higher than the quotes. Maybe certain project types require significantly more unbilled administrative time, so make sure you price accordingly. This pattern recognition does double duty. It improves your profit margins and it stabilizes your income for tax planning purposes. When your estimates become accurate, your profit becomes predictable and your quarterly estimated taxes becomes manageable instead of panic-inducing guesses. Now, you need to create an estimate template that includes tax considerations. Your templates should show you not just the price to the client, but what you expect to profit after all costs and your expected tax obligations on that profit. This isn't just for improving estimates, it's for managing tax obligations in real time. If your actual profit margins are running higher than expected, you know to increase your quarterly estimated taxes payments, and if they're running lower, you can adjust before overpaying. The real transformation is confidence. When you know your formula generates 45% margins, you know what profit to expect. When you know what the profit to expect, you know what taxes to plan for. No more April panic. No more estimated tax penalties because you guessed wrong. No more cash flow chaos because you didn't set aside enough. Right now, you may be leaving money on every estimate you create, and you may be setting yourself up for the tax problems. So if you think you're guessing at pricing or guessing at cost and guessing at what you'll owe in taxes, guessing creates chaos, stress, and painful April surprises. The 45% profit formula isn't about charging more. It's about charging correctly and planning for taxes wisely. It's about knowing what you'll earn and knowing what you'll keep after the IRS takes their share. Stop the profit roller coaster and the tax panic that comes with it. Stop wondering why you cannot get ahead despite working constantly. Stop facing tax bills you didn't plan for because your profit estimates were fantasies. Your profitable pricing formula is waiting in your numbers. Every Monday at 7 p.m., we gather at the Clarity Compass Method membership, or if you're ready to hand this off completely, our white glove bookkeeping services will track everything, analyze your patterns. Remember, every estimate without a data-backed up formula is a guess. Every guess is a gamble, and gambling is not a way to run a business or plan for tax season. Thank you for tuning in to Tax Season Saturday, and I'll see you in the next episode.
Hey, thanks for joining this Saturday's tax season special. Don't forget, you can join the Clarity Compass membership for weekly support or reach out for our white glove bookkeeping services. And remember, we're not lawyers or accountants, just your guide to clarity. Catch the next Saturday episode in this special tax season series. See you then.